Well, Adrian van Tiggelen, Senior Investment Specialist at IG Investment Management, joins us now. Thank you very much indeed for joining us here on The Pulse. So let me start by asking you... Good morning. So let me start then by asking you about those comments. You're saying that we're now entering a prolonged period in which large companies will outperform the small cap companies. What's the driving force behind this view?
Now, several driving forces. Firstly, as you know, small caps have outperformed almost consistently in the last 10 years, with the exception of 2008, and have become quite expensive. A large premium to large caps. That's because they grow faster than large caps. The problem is, for that high growth, they need financing. And as the previous speaker also pointed out, it's more difficult now, especially in Europe, in the credit crunch which is developing, but also in other parts of the world, for smaller companies to access bank credit. And in the US you have at least some alleviation by the fact that they can also access the high-yield bond market. But in Europe that's much less developed, that market, and so for them it's more difficult to get credit, and it will also mean more difficulty to finance future growth, and it will mean probably underperformance in the years hence, because we think that the credit crunch will stay among us for some time to come.
Okay, so then let's just take a look at your position, where you stand when it comes to industry groups, with all that in mind, Adrian, because I know that you like stocks in food and larger drug companies, so you're obviously going defensive on that front. In a similar vein, you're also liking tech and energy stocks. And then you're also warning that it's really too early to start playing the cyclical game. What specifically do you need to see for those cyclical stocks to then become more tempting?
Yeah, good question. One very important factor would be the ECB stepping in a big way. So basically the ECB starting QE and in a generous way, and having that money used by either the IMF or EFSF or EMS to basically stimulate the markets further. That would probably prevent a more severe recession. If the ECB doesn't step in, we expect quite a severe recession. If it does, we expect only a mild recession in Europe. And that would give cyclicals, basically, which are quite attractively priced, a chance to outperform for some time. But I think that would be the most important trigger, the ECB.
I mean, given the difficulty of the investment climate right now, you've already talked about recession and credit crunch here in Europe. We've also had many corporates revising their profit forecast for earnings going forward. How positive can you be even on those defensive stocks?
Now, they will still, in all likelihood, grow their profits next year. Overall, we think you'll see a modest profit decline. In Europe, 5 to 10%. In the US, 3 to 5% next year. But we think that in these specific sectors, so energy, large technology, pharma, food and staples, you'll still see profits rising modestly. But we should not forget that these companies, except for technology, also tend to pay quite good dividends. So they provide a source of income. And we think that their internal diversification, so many of these companies are global companies, so inherently have exposure to emerging markets and to all the growth sectors, becomes more attractive now, certainly at a time when in Europe there is more doubt about the credit ratings of governments, the credit ratings of these large multinationals. We can still build on and still trust for the future.
All right, so we've covered where you stand on Europe. If we just turn to the US for a moment, Adrian, I know that you prefer the market there. You're backing America to avoid recession, first of all, and you're saying that growth will be, but nevertheless you do say growth will be low. You're expecting to see a continuation of tax credits. You think the Fed will go for another round of QE next year. So, I mean, against that sort of backdrop, if you like, where do the best opportunities in that market lie?
Yeah, we think the market implicitly, by pricing US Treasuries at 2%, has given the US its blessing to continue to stimulate the economy. That will probably keep the US out of a recession unless we get a severe recession in Europe. Then I think it will be tough for the US. It means also that in the US we are more happy to have a slightly more pro-cyclical bias than in Europe, especially for those companies which have a very high emerging market exposure. But even there, on the whole, we still prefer healthcare, staples, energy, technology, those four sectors, because they are still quite attractively priced for the modest growth they deliver.
Okay, so there you have Adrian van Tiggelen with the somewhat defensive perspective, if you like, Senior Investment Specialist at ING Investment Management. Thanks for your time.